Hello everybody, Luke Gromen, founder and president of FFTT, Forest for the Trees. Happy Sunday night to you. Wanted to reach out to everybody who might be watching this on replay to say hello. Thank you for watching. As we noted, we're going to have a new format this week. We're going to go 90 seconds, 2 issues that I think are interesting or most interesting, things that grabbed my attention recently. And then if there's any questions, we will open it up for questions. So first off, the overwhelming consensus at this point seems to be that the U.S. holds all the cards in terms of the trade tensions. That grabs our attention or is interesting to us really for 2 reasons. The first off is that broadly speaking, many of the same U.S. analysts and media voices that are reporting that the U.S. holds all the cards are also the same people in a lot of cases that saw no chance for Trump to win. They saw no chance for home prices to fall nationally. They saw no risk for contagion to the financial system once home prices did start falling nationally. And the common thread in all these things is linear thinking, which can obviously be very dangerous because you cannot foresee nonlinear outcomes. So that's one reason that's caught our attention. The second reason is that the Wall Street Journal noted last week that Chinese Vice Premier Liu He laid out his views of more than 100 U.S. demands. And when you looked at it, 30 to 40% could be met right away. 20 to 40% would take years to negotiate. And 20 to 40% they said can never be negotiated. And so there seems to be a very broad gap between the position that the U.S. holds all the cards and the Chinese position. They seem to be mutually exclusive positions, and markets don't seem to be believing that yet. The second thing that caught my attention recently, I tweeted about it earlier today, was that Augustine Carstens, the general manager of the BIS, noted that the U.S. economy is firing on all cylinders. And to us, we're a little skeptical, I guess. With no doubt the U.S. economy is doing well. We wouldn't argue that. However, we recently read that the U.S. life expectancies fell for the 3rd straight year in 2017. That's the first 3 consecutive year decline in U.S. life expectancies since the Great Flu epidemic of 1916, 1917, 1918. And so anytime you get something like this real happening on the ground, and importantly, a lot of these were attributed to deaths of what the Wall Street Journal called last year deaths of economic hopelessness. And so it's ODs, it's alcoholism, it's suicides, and there's sad, horrible stories. What it tells you, though, is when these are what are driving you to have the first 3 consecutive year decline in life expectancy in 100 years in the United States, there's just something more there that's not being looked at, not wanting to be discussed. And our point is that we would expect populism to continue until some of these issues are somehow addressed. And then before we check in so those are the 2 things. Before we check in with any questions on the followers, as a reminder, I'd like to invite you to, if you're interested in following what we're up to, check out our website, FFTTLLC.com. You can also email our colleagues here at info@FFTT-LLC.com if you're interested in learning more about our weekly report, FFTT Tree Rings. With that, the first question was, Trump said a week and a half ago, called the dollar the cherished dollar, which seemed to be a reversal of the prior stance of the Trump administration on the dollar. And what do we think of that? And it's interesting, since then, not more than a couple days later, he reportedly was complaining about the Fed up in the Hamptons at a fundraiser at the Hamptons. And so he sort of did a 180 to, as far as we can tell, on the dollar twice in, call it 72 or 96 hours, which does seem to be a bit par for the course, unfortunately. Ultimately, in terms of why we think he may have said that, the cherished dollar point, or if we think there's a big change, I think it may have been a negotiating tactic. The Trump administration seems to have one big weapon to use. It seemed to realize that the dollar is a very viable weapon to squeeze emerging markets, and so they're swinging that weapon. They, of course, in our view, we think they need to be very careful. The margin of error, early on, 6-8 months ago, there was open field running. They could swing that bat very hard without hitting any of their own porcelain, shall we say. The margin of error in terms of how hard they can swing that bat without starting to hit the U.S. economy, we think is shrinking notably, as you've seen recently from some of the housing data, some of the auto data. Higher rates and the stronger dollar is beginning to bite into the U.S. economy as well. So I'll stop there on that. Saw one question about the yield curve. To me, the thing, two interesting things were mentioned by Fed officials this week. I believe you had Bostic, who said that he would not tighten to invert where he's knowingly, he would not vote to tighten to knowingly invert the curve, and I think that was a long-standing position. And I think he had Bullard on CNBC on Friday say much the same thing, saying that we don't want to ignore the yield curve. We ignored it in 2000, we ignored it in 2007, and in both times effectively saying we were wrong, which I thought was a very interesting point to hear from Bullard, particularly coming on the heels of Bostic. To me, it provides us a very valuable signpost. And by that I mean we now know the Fed is actively talking about the yield curve. We know they, in those discussions, are talking about them in the context of 2001, 2007, and that they over-tightened, they didn't heed the warnings. And so to us, that is, now we'll know from here if they continue to tighten. That to us tells us that what we've referred to as the shoot the hostage situation, where there's tightening going on, and that they're going to keep doing so. If they keep doing so, I should say, it's more about the dollar and less about what the economy is doing at that point. So we'll see if we have any other questions out there. Like I said, if you're interested in hearing more about what we're up to, check out our website. Otherwise, let's see. Any other questions? Nope. I think that'll do it. So, had a couple questions. Had the 90 seconds. Try to keep it tight, and we're going to try to keep doing that going forward. Otherwise, thoughts on potential financial spillover from Turkey. We're going to keep going here. When I looked at the last thing I saw is the U.S. and parts of Europe had the biggest loans outstanding, I guess, to Turkey, and so those are areas you would watch for at first. Let's see, thoughts on how should a view money supply, a prudent investor, how should a prudent investor view money supply expansion? That is a very big topic for the. I'm going to have to take a pass on that one for now. I think ultimately you have to look at it in the context of a number of other dynamics in terms of current liquidity conditions. What currency are we expanding the money supply in, etc. What's my view of inflationary pressures? To me, again, you get into what inflation is still relatively tame. I think ultimately, though, part of what has been driving populism, we have thought about populism. Populism is merely a marking to market of a decline in real living standards over an extended period of time, and so populism caught a lot of policymakers by surprise. That makes sense because they're not looking at properly measured inflationary statistics for big swaths of the middle class, and so overall inflation is low. If we looked at a basket of goods that the middle class really spends money on, healthcare insurance premiums, tuition or health or educational expenses for their kids, rent expenses or home prices. If we looked at all of that, then I think you'd be looking at a bit of a hotter CPI number, if you will, than we are. But that's look, that's the politicization of CPI is something that has happened for a very long period of time in pretty much every place in the world. And so, to us, the real tell is this outbreak of populism. And I was telling you that perhaps it's gone a little too far. Let me see if we got some other questions here. Any concern of emerging market peak debt possibility? Clearly, if the dollar keeps strengthening, I was just looking at something on Twitter earlier today about some of the maturity rolls that you have for emerging markets over the next 12 to 18 months. They are very significant, $1.2 to $1.5 trillion from the data I saw from Daniel Lacal, I believe I was looking at. It was a great chart he put up. To me, the $64,000 question is you can't look at these roll numbers or the EM pressures in a vacuum. I think you have to look at it as almost a race to the cliff, right? So it's not only about what's the EM or emerging market debt roll. It's also what's the U.S. Treasury debt roll. The U.S. Treasury debt roll over the next 12 months is a substantial multiple of 1.2 to 1.8 trillion. Obviously, the U.S. Treasury is not going to have a problem finding dollars. They can always get the dollars, and push comes to shove, the Fed will help them get the dollars. And to us, the game is less, will this hurt will a dollar shortage hurt the emerging markets? It will. The question is how much longer do we have until pain in the emerging markets and what we're force economic weakness in the U.S. such that the Fed has to start helping the U.S. with their debt roll, which is, like I said, an order of magnitude bigger than emerging markets. Let's see here. What does German minister comments about an alternative to SWIFT suggest about their readiness? He would suggest that the readiness of the system, at least right now, is probably not where it needs to be without a crisis, or they are simply not willing. Perhaps they're signaling that that they're thinking about it. That's when you communicate. Perhaps that's a communication to to the U.S. side that once you push the Germans to start actually talking about this, there's got to be some element of a recognition that they're frustrated with the way things go and that they're willing to start looking at it. There are practical and technical, mechanical things you would have to get set up ahead of time. Wouldn't sound like those are ready to go yet. Thoughts on Trump using ESF to buy Italian debt? Have the inmates taken over the asylum? Could he do it? Absolutely, he could do it. You look at the New York Fed's website. The ESF is a big fund, and it is at the sole discretion to be used as the Secretary of the Treasury, and President see fit. And they don't have to report to anybody how and when they do it, which is a really nice fund to have, nice thing to have. And assets at least, or statement of financial position of the ESF as of June 30th was 95 billion in assets. So it's a real number. Obviously, you can't move things around that much, but you can certainly have a big market impact with that kind of money. Obviously, some of the money's deployed elsewhere already, so it's not like that's just sitting around in dollars. It's already, some of it's already in certain FX, some of it's in SDRs, etc. So, look, and have the inmates taken over the asylum? We're in a currency war, so there are competing political constituencies. It's been a long time since we've been in one of these. So this does speak to the point I've made in terms of these non-linearities. When I referred to it earlier regarding the overwhelming consensus that the U.S. holds all the cards vis-a-vis China and the trade war. Maybe that's true, maybe that's not. But these situations, they are very they can change very quickly, very non-linearly, and I think that's important to keep in mind. Let's see. Does the Fed roll out QE8 during the next crisis? It's interesting. I'm starting to hear rumblings of some of the big banks talking about the need for the Fed to supply more dollar liquidity.
much sooner than consensus expects right now. I think this speaks to some of the nonlinearity we were talking about before in terms of analyzing what's going on. I think it speaks to some of what's going on with the U.S. funding situation. I don't think it's appreciated that ultimately, if we do have another emerging market crisis, the last time we had one in the late 90s, if you will, U.S. was running a surplus. U.S. federal debt was much, much lower than it is today. U.S. demographics were very different. We have a late 90s type emerging market crisis. The dollar's going to go up, sure. We're going to need to find someone to buy probably $200 to $300 billion a month in incremental treasury issuance. And I don't see who that is ex the Fed. So that's been our point all along. That could you see a dollar spike? Yes. Our view is that such a dollar spike would be at most an intra-quarter, maybe an intra-month, or even intra-week thing. So would the Fed, to answer your question directly, the Fed probably will need to get involved in some capacity if there's another crisis. Under Clinton, the numbers were skewed. Yeah, well, it's interesting. If you talk to people who have been in the business, worked in Washington a long time, the numbers have always been skewed. If you read the book Lords of Finance by Liaquat Ahamed, which I would recommend everybody to read, it's a phenomenal book. But they talk in that book about how the Hoover and Roosevelt administrations, were pressuring the government statistics organizations back then to make the numbers look better than they otherwise were. So this is this isn't something unique to the U.S. Obviously, there are other sovereigns in the world, China, whose data have been called into question at certain key junctures and at times, and I don't think that's any different in this case, regardless of who it is. How do I think markets would react to another round of QE? I think the dollar would rise, I think risk markets would rise tremendously. I think commodities would rise. I think the dollar would fall sharply. I think Treasury yields, quite frankly, could fall in all of that. I think emerging markets would do really well, and it's basically the exact opposite of how everyone's positioned today. I wouldn't say it's incredibly overweight, but people are now overweight the dollar, underweight emerging markets. It's not at full extremes yet, but it's getting a bit more extreme by the week, it would seem. It looks like that's about it. So thank you guys very much for joining us on a Sunday night. I hope everyone has a great week, and look forward to talking to you soon. And like I said, check out FFTT-LLC.com for more information. Otherwise, we'll talk soon. Thanks, everybody. Take care.